This video is sponsored by Terrell Hutton, who makes the invisible investable. Today on the CEO Barbecue, copper and molybdenum development in central British Columbia together with Surge Copper. But if you're short on time, subscribe to our free newsletter, and once a week, we'll send you a 5-minute summary of all interviews we put out. resourcetalks.com for a free weekly newsletter. Now, although this company has paid us for the production of this video, you should still understand that we are not financial advisors, and this is not intended as financial advice. It is a broad, general, and impersonal piece of information intended only for those who know and understand the risks of junior mining, of which there are many. Before moving on, read the company's official filings on setterplus.ca and do your own due diligence. Pause the screen and read all the disclaimers I've shown you because your capital is at risk. If this isn't clear, go to the last section of this video for a longer explanation of the risks and biases, and do not consume this content if you don't agree with everything said therein. Moving on, this is not Surge's first time on the CEO Barbecue. Leif's been on multiple times over the last couple of years. So if it's your first time hearing about the company, I'm going to post a link to a playlist containing all those previous interviews. Please watch those first if you haven't. They contain the basic smell test, the basic grilling and all that, which we're not going to be repeating here today. Although there's going to be at least a little bit of grilling. This is the CEO Barbecue after all. In a nutshell, though, Surge Copper's flagship asset is the Berg copper project. It's a copper moly project actually in west central British Columbia. And it's roughly 100 kilometers northwest of the town of Smithers. Berg is a porphyry. It's actually a alkane porphyry, and it's got mostly copper and molybdenum in it, but it also has some silver byproducts and a little bit of gold in it as well. It does have a lot of copper and a lot of moly, though, and they recently did a PFS on it. So a pre-feasibility study was published about 2 weeks ago showing a rather large NPV as well. So this is a $4.6 billion asset with a 24% IRR and a payback of just under 3 years under the assumption of $475 copper, $20 moly, $45 silver, and $3,500 gold. 28-year mine life sees close to 9 billion pounds of copper coming out of there. And the first 5 years, they're actually averaging a lot of it too. So they're averaging 416 million pounds per annum with a C1 cash cost at under $2 per pound of copper equivalent. Mines that big don't come cheap, though. And so the initial capex to build this thing here is $4.7 billion, and the sustaining is $1.7 billion for a 120,000 TPD concentrator, as well as a bunch of other stuff, of course. So the connection to the BC hydro grid and the conveyor to the processing plant and so on and so forth. So we'll talk about that later on, hopefully. Following the release of that PFS, they're now preparing the 2026 field program that includes some geotechnical and drilling, as well as some resource conversion drilling, along with environmental baseline work to support permitting, of course, which, we'll definitely talk about that later on in the conversation. Briefly, though, not unimportantly, Surge also holds the Ootsa property. So it's not only Berg in their portfolio. Ootsa has several porphyry deposits on it located adjacent to the past-producing Huckleberry mine. But that asset, so Ootsa, hasn't really seen all that much material work in recent years, as obviously all the efforts have been directed at advancing Berg. But maybe that's changing or maybe not. I don't know. I do intend to figure out later on because it's been a while since I've gotten an update on what the plans are there. A bit of the details here and some of the numbers. Surge is listed as, Surge, but without an E. So SURG on the TSXV in Canada, where the average trading volume over the last 3 months has been close to 1 million units. Although that's actually changed a little bit over the last 10 days, where the average volume has been 2 million units. Market cap is almost exactly $201 million, and with 386 million shares outstanding, today this is a 52-cent stock. And this is actually a good point for me to shut up because I do have a question about that. But first of all, Leif, thank you for being here today.
Yeah, thanks very much. It's great to be back.
Pleasure is mine. I am looking forward to this. I've been looking forward to this since our last interview, actually, since you told me that this is coming. And although the pleasure is mine, I think the first question might be a little bit less pleasant, but the market maybe doesn't seem to like the numbers that I just went through, because the stock sold off from 85 cents at a high just before that down to like almost 50 cents now. How come? What's your read? What does the market not like, or what's going on there?
Yeah, I would I'll just get right to the point on it. It's a bit of a structural thing around an existing owner deciding that this is the right point for them to step off the train. So I'll go into some of the details on that. But look, so we're having this conversation on Friday, 2 weeks after putting the announcement out. So over that sort of 10-day period, I've basically been in back-to-back meetings with lots of different investors of all kind of stripes and sizes and just different parts of the world and different focuses. And I would describe the tenor of the feedback as being uniformly positive. So you highlighted a few things there around, Capex as being one area where there is a little bit of kind of focus as, hey, is this the reason that the share price is not, getting a fair response sort of thing? And we'll get into all that. But the simple answer is no. I think the fundamental results are excellent, and the fundamental, like the reception to those results is really positive. And the first several hours of trading on the morning that we put it out, we were up 15% on strong volume. And over the last 10 trading days, we have traded 40 million shares, 45 million shares as of right now over the last 10 trading days. So the numbers you were quoting were probably just constrained to just the TSXV. But if you add all the different, alternative trading venues in Canada, we got different, direct market access type platforms and stuff like that. The total volume is 45 million.
Wow.
And what's happened here is one of our largest shareholders, it's a corporate, Centerra Gold. They have decided to exit their position. And there's a bit of history here, and there's a bit of logic to it as well. So I'll kind of go through my view on the history and my view on the thoughts. So we acquired this project from Centerra about 6 years ago, essentially at the end of 2020. It was originally an earn-in agreement. So it was a deal where we would invest some money in the project and we would end up with a 70% interest in the asset. We would form a joint venture where both parties would be contributing, and off we would go. We completed our obligations under that agreement in 2023, and we came back to the negotiating table and basically said, we don't think this earn-in agreement actually makes sense for either party. This is a big copper project in a copper district. We think it would be better for the project if it was, clean ownership, and we could go and solicit, the interest from other strategic counterparties that were interested in copper. And conversely, from the Centerra side, I think having a non-operating but contributing 30% interest in a project like this with no offtake rights or anything like that is a bit of a funny spot to be in, right? It's not a really like marketable JV interest, and it would just be non-core for a medium-sized gold company to be doing something like that. So our pitch to them in 2023 was, I think, a win-win proposal. It was, hey, can we move you out of the asset into the top co? That way we will have 100% clean ownership of the asset, and you can ride with us as a corporate shareholder. And, there's going to be some logical point in time where you'll get liquidity in a much easier way there than trying to market your 30% JV interest. And I think that pitch made a lot of sense, kind of appealed to them. And so that was the deal that we ended up putting in place a couple of years ago, where we consolidated 100% ownership in that property, in the Berg property, and we issued a number of shares to Centerra that created put them in as a 15% shareholder at that point in time. So their maximum ownership position was like 33 million shares and change. They were a 15% shareholder. And they never contributed cash into the company, which again is logical. There's nothing untoward there. So every time we raised some money, they took a little bit of dilution. Their interest kind of ticked down from 15% incrementally. And then our most recent financing that we did in February of this year, the second tranche of it, including a piece that our other big shareholder, ARM, was contributing to, that didn't close until March. And so it was that last tranche that closed in March that saw Centerra finally be diluted below the 10% reporting threshold. So once you get past 10%, below 10%. Under the Canadian system, you fall out of the early warning reporting system. You don't need to report your transactions. So they kind of ceased to be an insider at that point in time. So they never sold any shares up till that point in time. And then as of March, they ceased to be an insider. We obviously have pulled some registers at various points in time throughout the recent months, and saw that they had lightened up a little bit in the market. Obviously, it wasn't in a disorderly fashion because the share price did very well. It climbed from 50 cents to 85 cents over that period. So I think they were tactically selling down their position in a very light way during that period of time. But I think they held a very, a big portion of their position, probably more than half of their position, leading into the pre-feasibility study announcement. And I'll pause and maybe give a flavor of how a corporate would be thinking about stuff like this. Like they're not a shareholder of SURG because they want to buy SURG. They're not a strategic investor in SURG in that kind of typical sense. They own shares in SURG for the reason I just described. It was consideration that they took in exchange for selling us an asset, and they were planning to hold that until some logical point in time where they could achieve liquidity at a good value. So there's two general options for that. Option A is you hold until the end game, whatever that may be, or like you're holding perpetually, or you decide you're going to hold until some intermediate point in time. So if you look at intermediate points in time, this is a pretty logical one. We have reached a very significant milestone. There's a big announcement. We've obviously done a lot of marketing leading up to this. We're doing a lot of marketing on the back end. So you'd expect that there's a lot of visibility. There's a lot of, eyeballs on this. There's a lot of investors on the sidelines that would be, benefiting from all this new information, that liquidity would be available in the market for these shares. So again, it's a pretty logical juncture for a corporate in the position that Centerra is in to say, this is the point in time when we kind of step off the train. And from that perspective, there's really two ways to go about it. You can either make use of the public markets, or you can try to do it in a bit more of a coordinated fashion where you are, working together with the issuer or working together with, third-party banks to try to distribute that stock in an organized fashion. And in this particular case, again, I can't really speak to this decision. It's not mine. I don't know all the factors that they would have weighed, but they opted to sort of maintain a bit of a veil of secrecy around this and just sort of use the public markets to distribute this stock. And again, we have a few data points on it. We've pulled some registers throughout this period of time, and we can see that there was a large amount of stock that dropped down in their positions. So I wouldn't be surprised if they have sold something on the order of 20 to 25 million shares into the market over the last 10 trading days, during which time the total volume has been 45 million shares. So, close to or above 50% of the total volume, which I think tracks with the sort of significant downward pressure on the stock. I believe that's done. I believe they're out now. The end of the quarter is a few days away, so it would be logical for them to want to have that all kind of cleaned up by the end of the quarter, so that when they're putting out their financials, the equity investments that are booked as current assets held for sale will be dropped to zero. So I think that's a very simple deadline. So I'm pretty confident that we're past this now. And again, as of Friday, the day that we're having this chat, good volume in the stock, 4.5 million shares. It's up 15%. So I think this is a little bit of a blip that we've had to live through here. This is just how things happen like this. Sometimes corporates need to take these steps, and it's their prerogative. And I can whinge about wanting things to be done a little bit differently, but public markets are there for a reason, right? Liquidity comes at a cost. It is what it is. So here we are. But we're really thrilled with the fundamental results that we've put out. I've been out communicating that message, and obviously it's garnered nearly $20 million in market buying on the back end there, which is fantastic. I think those buyers are going to be pretty pleased with the the price that they were able to get for those shares as well.
I do want to know more about that, but people listening should also want to know more about Tara Hutton, who doesn't only make the invisible investable, but they've made this video free of YouTube ads by sponsoring it. Tara Hutton is built for the people who are tired of going through boring PowerPoint decks and geological jargon when they're analyzing mining companies. It's a digital platform where the data, the story, and the context sit together so mining investors can use visuals to understand the why without needing a geology degree or a week off work. And if you're on the company side, it's a great way to present your project like a serious operator with everything investors keep asking for in one place. Contact them at terrahutton.io. Very good explanation there. It seemed like you might have thought about this for at least a little bit longer than I have. So I do appreciate the view there. When I look at some of the complaints that I could find, at least online, they do seem to surround that Capex number mostly, but also daily throughput capacity is mentioned on a copper basis only, or on a copper only basis. This question is about permitting and so on, and we'll dive into each one of those. But is there a hope or expectation on your end that some of these numbers could get materially better toward the FS, or what kind of a change are you expecting between now and the next major step here?
Yeah, sure. I want to add one more thing. So I about the previous discussion, like I don't begrudge Centerra for this. Again, I think their actions are logical, and there's a whole bunch of considerations that they would have been balancing in deciding how they wanted to undertake this action. So I got a lot of respect for them. They've been very supportive shareholders for over 6 years. So I wanted to make sure that point was came across the right way. That it adds kind of confusion over a couple weeks period where people are trying to figure out why the share price is doing what it's doing. So I think people deserve to know, and we've got the I think the data to support that, but it's not meant to be a kicking sand type comment. So back to your question about how things might evolve. So we'll get into the details here, but I think the development case being put forward in the pre-feasibility study is like a really prudent and conservative one. So not just the size of the capital cost, but like the concept of the construction period and a lot of the different design components. We were very intentional about thinking about risk reduction, simplicity, and just putting forward a plausible development that was going to minimize risk in permitting and all sorts of things. So where can upside come from? I mean, there is what are some of the different levers to pull? So throughput, I think 120,000 tons per day is probably the maximum size we're going to go through or go to here for this project. I think that's ultimately limited by the mine geometry, the ore deposit geometry. That's pretty. It's big by Canadian standards. It's kind of medium by global copper mining standards today, and I think some of our peers in Canada, meaning pre-production development assets, are at or going to be exceeding that size. So I don't see anything unusual there, but we're unlikely in the feasibility study to see that doubling or anything like that. When we get further into the conversation around Capex, there's a lot of embedded optionality in how the mine gets developed. And so we put a particular case forward that I think is solving for a particular outcome, which is maximizing returns on capital and achieving some of these conservatism, plausibility of how it's built type objectives. But embedded in that is there are other options if you wanted to prioritize reducing upfront capital costs, if you wanted to prioritize smoothness of production profile. Those things are all totally possible to do with this project, and you would get different Capex numbers and different production profiles and different return profiles. So I think the one that we've put forward is conservative on the capital cost side and actually demonstrates really quite good and quite exciting return profile. As the project advances, there's certainly opportunities to see things like the mineral reserve base get bigger. So that would equate to mine life extensions. but those aren't going to be transformational from an NPV or IRR perspective because you're talking about stuff that's, tacked on to the end 30 years from now. I think in terms of, what's really going to drive NPV and IRR is Capex and what's going through that mill in the first 5 to 10 years of the mine life. And I think what we've captured in this PFS is a really good demonstration of what the Berg deposit can deliver in a very plausible development pathway that would not strain credulity in terms of the executability of the plan.
What was the reaction? I know this seems kind of unrelated, and I'm definitely going to pick up on some of the things that you just said. But what was the reaction of the First Nations in the region that you're dealing with? Have you spoken to them already? Has anything changed there?
Yeah, absolutely. SURG has been operating in this district for nearly 20 years. So we have like members of our management team. I think you've probably talked to Shane Ebert at some point or another, but he's our president and VP exploration. And so through individuals, we have continuity of relationship with First Nations leadership dating back 20 years. Of course, our efforts there have evolved over time, especially with the acquisition of the Berg project. It sort of changes the locus and the footprint and all that sort of stuff. And it certainly in recent years, anticipating ending up where we've ended up now, we've really ramped up those efforts with First Nations engagement with a focus on kind of development activity. And even really recently, in the last 6 months, we hired or appointed Jennifer Anthony as Vice President of Environment and Regulatory Affairs. So she brings a lot of expertise to what we're doing around the EA process that's ahead of us. And so, yeah, we have had many years of engagement efforts with some of the key nations and are like expanding that reach now. Bringing in new groups and really trying to set the stage for a productive and successful environmental assessment process. So just as a little bit of a sidebar here, the BC environmental assessment process has a formal component of it in the early phases of that deal with kind of identifying who the participating nations are going to be and articulating what the engagement plan is. And so project proponents can do themselves really big favors. Like you can do good work there in front end loading that, where you do early engagement. You sort of build these relationships years in advance. You make sure people understand the details of the project. You actually invite them to visit site and to sort of provide input on what their focus areas are and valued components are, and you kind of share that experience with them so that design decisions, even at the early stage that we're at PEA or PFS, reflect some of that knowledge. And we've tried to do that along the way so that when you enter the environmental assessment process, the Crown steps in, the government steps in, and they'll have this sort of formal process to determine who the participating nations are and assess what the engagement plan is. And ideally, the proponent would sort of respond to that saying, yep, we're already sort of like in agreement with these groups, and we've got agreements in place, and we've got capacity funding, and they've been to site a bunch of times, and everyone knows what's going on. That's what we are aiming to achieve. So I think we've got a really good foundation there, and we're doing a lot of work in that area right now. It's been a big focus of my time over the last 6 months, and obviously Jennifer's time as well. And so I think we're in a great spot there. And we had a few support quotes in the press release that I think were intended to provide a bit of that flavor. We didn't, So there's a couple quotes there from some key leadership in the area that is just indicative of the types of relationships we have, the approach that we're taking, and the fact that I think folks are happy to be working constructively with us on the work that we have ahead of us to go through assessment on this.
Really, what I'm doing with these questions here is essentially trying to gather the overall sentiment, because I think me as a retail investor who never leaves this dungeon and only spends his time online, I can see a lot of the retail commentary online, but I wanted to see what everybody else thinks, and so like it's good to know what Centero thinks, and as well as what you can see in the news release itself from the government and in the First Nations. I'm also going to ask you about your view on things, but just before that, before you forget it, I didn't ask you about ARM. What do they tell you when they so they're pretty big? Should I call them strategic? I don't know if that's fair, but they're a big part of the story.
No, they're like the definition of a strategic investor, which is a corporate entity that has a long-term strategy that is, the reason why they're investing in this. They're not a financial player. They're not here to necessarily, make a flip or make some return on their investment in the shares of SURG. They are, they own shares as part of a long-term strategy. That's what I that's what I think strategic investor should mean. So they're a South African diversified mining company. There's not a lot of opportunities to grow in copper in South Africa. So they, by definition, if they want to make investments in copper, they kind of have to look abroad. And they did that. I think they did a global search of lots of different opportunities over the last several years, and have alighted on this one, and they've secured a 19.9% interest in one of Canada's largest, most high-quality development stage copper projects for, a total outlay on their part of like 16 million, something like that. So I think they're pretty happy with that. I don't want to put words in their mouth, but it's a great relationship. We have a lot of mutual respect. I think they're very happy with their strategic position here, and I think they like the way that the Berg project is advancing and developing, and the way that we've positioned it ticks a lot of boxes for them. Maybe just to pause on the kind of South African mining context, because I deal with this question a lot, and the response I often give to people is South African-based mining companies of all stripes have been, for the last 15 years, somewhat focused on outbound M&A. I think there's a really well-established trend of that, whether you're talking about, Anglo American or Anglo Gold Ashanti or Goldfields or Sibanye or Impala or Harmony. All of these companies have made multi-billion-dollar acquisitions in places like Australia, Canada, and the United States. So for ARM to be adding themselves to that list by making a small investment in a Canadian copper project is completely logical. It's not illogical at all. I just think the name is not well known. It's not a household name in junior mining land, but it certainly is a household name in South Africa. They have a stellar reputation there as operators of big mines. So they operate one of the largest iron ore mines in Africa. I had the pleasure of visiting it in February this year, the Kumani iron ore mine. They operate big coal mines, PGM, nickel. They're a huge manganese producer. So again, diversified mining company looking to invest abroad, and copper is quite logical. They are sort of a sister company or related party to Harmony. So Harmony is a bit more well known by folks. They're a JSE listed South African based gold mining company. ARM is the second largest shareholder of Harmony. They have the same chairman, and there's some overlap between the boards there. So they're kind of related entities. And Harmony has, just as a very similar kind of parallel example, in the last few years, they have acquired the EVA project from Copper Mountain. It's a Queensland-based project in Australia. And they've also acquired MAC Copper, the CSA copper mine in New South Wales, I believe. So they've splashed out, inclusive of the capital costs for EVA, they will have collectively invested a few $billions to build a 100,000 ton per annum copper business in Australia. I think people don't even bat an eye at that. It's just yep, totally logical. Well, ARM is a sister company, very closely related company, making a order of magnitude or 2 orders of magnitude smaller investment so far in a Canadian copper project. And it shouldn't be an issue. People should just like literally move on from it. It's very, very, very logical. And for what it's worth, one of ARM's business partners in South Africa, it's an entity called Dasor. They're partners in their manganese business. That entity is now, I think, the largest shareholder of Marimaca. So they stepped in like a year or two ago to acquire Tembo's stake. So again, like South African manganese diversified mining company, strategic investment in a Chilean copper project. Like just again, another data point in that trend. So we're very happy to have the support of ARM. I think they're really fantastic guys, very smart operators. They have the potential to add a lot of different forms of strategic support to what we're doing as we continue to advance the business.
What do they want with you is a question that I've asked you before as well. But what about now? I mean, having seen the PFSs, has something changed? I guess they don't tell you all their moves, and maybe it's not something you can tell me, or maybe you could, but what do what do you think they want with you long term? Like, I understand they might be happy with the PFS now, but where's this relationship going is what I'm asking.
Yeah, they're very long-term oriented folks, as most mining companies are. These are long duration assets. Like if you encounter a mining company that's trying to flip assets on a short-term basis, like run for the hills, they are long-term thinkers. So they're focused on high-quality assets in safe jurisdictions, good fundamentals that they can be involved in building and operating and harvesting cash flows from for years to come. So that's their view on Berg, is it ticks those boxes. And I think their investment is indicative of them kind of securing a seat at the table to find their way into an operating level position in the asset. So that's kind of a complete answer to the question. I mean, there's a logical follow-on question, which is how do they get there? What does that imply for M&A and so forth? Well, yeah, I mean, that's all speculative kind of stuff. There's lots of ways you can slice and dice that. They could be a buyer of Surge one day and then undertake their own JV formation process if they wanted to do something like this in JV. They could be party to a consortium that is ultimately acquiring the company, or if maybe Surge decides that it wants to or has the opportunity to or needs to go it alone several years from now with a fully permitted mine and project finance facility in place and all these other kind of things that would need to be done. ARM would be there to increase their ownership position and contribute significant capital to the project through the current corporate structure. So I believe they would be there for that. So lots of different ways for that to happen, but I think there's a myriad assumptions embedded in all that. And what's important to understand is that they are a strategic investor that has a fundamental interest in being involved in a long life copper producing asset in a first world jurisdiction. And they've secured a toehold position to do that. And they're going to be focused on lots of different dimensions in the future about how to sort of properly navigate that process, as will we.
That's okay. That's good, because it's exactly where I wanted to go with this. So I asked you about what do your largest shareholders think? What does retail think? What does the regulator think? What do the First Nations or the local communities think? And now the strategic, what about yourself? Is that what you think the most likely outcome is for this? Or what are your thoughts now, having seen the PFS, again, everything in, Capex, the NPV and all that? What do you think is the most likely outcome for Surge long run? I mean, is it building the project or with partners, or you think someone comes in and takes you over?
Yeah, I'll answer the question in a fairly general sense. So from day one, my interest in this opportunity and the reason me and Christian and a quite sophisticated board of people are passionate about this is, I think we all subscribe to this big picture idea in copper that the industry's in secular growth. There's a lot of demand coming down the pipe. And it's really hard for the global mining industry to meet that demand, which is another way of saying there's going to be equilibrium prices are maybe a lot higher than where we are. So how do you capitalize on it? Lots of different ways to make that long-term bet. I think as as a developer, as a company like us, you always have a choice. I think if you look around the world in copper, you kind of have a choice based on geology to focus on what I always call small copper or big copper. And small copper is these deposits that are small, and they have the potential to produce order of magnitude like 20,000 tons per annum. These are great businesses. Christian has focused on these through things like Adventus and things like Nucir at Blue Moon. Foran is an example of this, obviously acquired for a very big number by Eldorado. The MAC Copper CSA asset I just mentioned that Harmony acquired would be another example of this. So these are, I don't want to disparage these things. They're very good businesses and they're a good way to go about expressing this view, but they're small assets. They don't produce like strategically significant volumes, and their mine lives are small, and so on and so forth. And just the reality of copper is that, like, the big picture is most people can paint a picture of like demand coming down the pike of an incremental 10 million tons of like unsupplied demand. And if you just translate that into mines, well, the biggest mines in the world, like Escondida, are like 1 million tons a year. And then there's a whole bunch of big ones in, elsewhere in Chile and Peru that are like 200,000-300,000 tons per annum. And then like the snack bracket that we're in is like 100 to 150. So the world needs like 100 Bergs or 50 Bergs and like 5 Escondidas or some like combination like that, just to meet some of the demand projections that are kind of visible right now. So I think there's a good market position for big copper projects like this. And so we've been focused from day one on not shying away from scale. So like we're not trying to position our assets as these like bootstrappable tiny little things. We view the Berg, Huckleberry, Ootsa district, which arguably could even include things like what Vizsla is doing up at like Poplar and the Thera discovery, like this kind of general area that we're in, as a huge copper district in Canada. If you tally up all the resources there, it's already like the biggest in Canada, and it's an established mining district. There's infrastructure everywhere. It's like, it's not pie in the sky to think about this thing developing over time to having multiple mills looking like any of these districts in Arizona or Chile, where you got a few different mines within 30 kilometers of each other. So that's kind of the big picture vision. And so what do I think about it? I think we've been consistently pushing in that direction. And I think what we've delivered with the pre-feasibility study at Berg is a tremendous result that aligns with that strategic vision. So this is one of very few copper projects independently owned, so junior owned, in North America, or you could even extend that to Australia as well. So kind of Canada, US, North America, Australia, that has the reserve base that we've put forward, that has a mine life of multiple decades, and where the production profile is like greater than 100,000 tons per annum. There's just not a lot of those things. And the one that we're putting forward, again, in terms of like how the components there, like how the mines developed, how the metals recovered, the environmental footprint, the infrastructure footprint, it's very simple. It's very plausible in comparison to other things in the high Andes or in emerging jurisdictions or whatever, right? Or even Northern Canada. Like this is a pretty bread and butter type proposal. So again, we view it as super logical, great return profile, like great sort of economic proposition, and is embedded in this like bigger strategic situation where we own a huge land position, like 142,000 hectares, 100% ownership, low royalty encumbrance. Ootsa is there as a advanced exploration project, gives us lots of optionality, communicates to the market that this isn't a one-trick pony. This is a district that in the fullness of time, the assets that SURG owns today could continue to grow and evolve and end up with, multiple production centers producing 500 million pounds per year of copper equivalent for 30 to 50 years. That's the big picture vision. And to me, that is, that should resonate extraordinarily strongly in the mining sector today. there's just nothing out there that's quite like it.
Well, it definitely does on paper, and only those numbers alone. What of course comes up is like, oh, dilution. How do you make that happen without, going through either massive dilution you yourself, or being sold prematurely at a valuation that doesn't represent the valuation that the asset has. So maybe talk to me about that in the context of dilution.
Yeah, so dilution. I mean, I view it as there's kind of two eras for these companies. You got like, how do you finance to get to a final investment decision? So that's all risk capital. That's like venture capital. And then, at or post a final investment decision, then you are talking about like a big infrastructure project. There's all manner of financing that comes available to you. So project finance is a key one. There's components of infrastructure here, like a transmission line, where there's there's bespoke pools of capital that can be available for components like that. So the way that we view dilution is really explicitly divided between those two eras, or those two phases of the company. So in the pre-FID phase, which is where we are at, we are like just well financed for that to begin with. Like, we have 20 odd million on the balance sheet right now, and we have a warrant that we put in place with some very long-term, high-quality shareholders that if exercised, if accelerated over the next couple of years, will bring in an additional 40 million. So we've kind of pre-wired what that dilution looks like, what the cost of that issuance is, and who is going to be providing that capital. That $60 million is going to fund a significant portion of the pathway to FID. I don't want to say it's like fully funded to FID, because there's a lot of embedded uncertainty there, and there's just no obligation to say that. But it's a very solid pathway, and the reason for that is, this project is. I think people have an intuition that copper porphyry projects take hundreds of millions of dollars to get to FID. And they certainly can, but I'll give you a flavor of what some of them involve that we don't have to contend with. Some of these big projects will have, they're just located in very challenging places where literally running exploration camps is like significantly more expensive than what we're dealing with. They're high elevation. Everything is like helicopter based, or lots of different reasons why just like drilling costs per meter are way higher than what we're dealing with. And then another key thing is, like, what is the nature of the work that's being done? We are dealing with a single large pit, so just one volume of rock. There isn't a lot of lithological complexity there, where you need to put hundreds of geotech holes in to understand what's going on. So de-risking like, we've declared reserves. There's more infill drilling to be done, but it's not necessary. Like, it's nice to have. We don't a 28-year reserve life with a 2-year payback period, like, you can underwrite that. We don't need to add more reserves to finish the task. It's a nice to have. It's not a need to have. What is a need to have is like the de-risking stuff. So geotechnical drilling, waste rock characterization, hydrogeological drilling, things of that nature. And because of the footprint of the project, that stuff for the Berg project is kind of simple. It's one pit. So as I was just saying, you don't need to pierce that pit wall 10,000 times to understand the geotechnical conditions. And then the infrastructure area for us, we've done an initial campaign of that. We're going to do more, but we sort of understand that it is shallow till cover. The drill holes you're talking about to characterize basement rock integrity there is like, they're like 50 to 100 meter holes. So it just doesn't add up very quickly. I would compare that to other porphyry copper deposits around the world, some of which are like multiple deposits. So you're just doubling up that risk, like the geotechnical risk compounds, because you're dealing with different ore bodies. Therefore, everything about those ore bodies is going to be different alteration systems, different weathering, different lithology. So you got to do all that work, twice. And then if there's an underground component, whoa, that adds a lot of costs, right? Block
Mhm.
caves, you need to like access the ore body. So you got to, drive a massive 2 kilometer exploration decline there, and you got a test cave, all manner of stuff. If you've got super complex metallurgy, maybe you got to do, bulk samples and pilot plants and things of that nature. So it does. I think people have a fair intuition that their kind of gut feeling is that these big projects often cost big dollars to get to like a fully defined basis. It can be the case. It's not uniformly the case, and I think we are in a pretty solid position where the simplicity of the project, the cost per meter of drilling just to operate there, all these things kind of go in our favor. And so, again, this is a long answer to your dilution question. I don't think there's a ton of dilution coming to finish the task at hand for us. The flip side to that of big capital project. Look, I think this is a project that's actually got a bunch of benefits to it in terms of like being well positioned to avail itself of the normal types of financing that big copper projects often seek. So I got a good slide that I use with my board in some of these meetings, which is like a bit of a cartoon of how are big projects like Berg financed. Well, the number one thing, the number one kind of bucket is going to be a project finance facility. So when you're talking about strategic metals like this, critical minerals, long mine life, offtake partners that are going to be, big smelters in Japan and other places like this, it is reasonable to expect that that project finance facility would involve the participation of numerous export credit agencies. So in Canada, that's like an EDC. In Japan, it's JBIC. In the United States, it's Exim Bank. It's so on and so forth. So these are all entities that, if you just follow the news around them, they have mandates for providing debt financing to critical minerals projects that have been ballooning in recent years. So they're using government money effectively to provide debt financing on favorable terms to spur on the development of these projects to help meet agency kind of goals. So export and development type objectives. Or in the case of Japan, like importing raw materials that they have no other way to access. So, I mean, you could make a pretty basic assumption: 40% debt capacity. The tenor of these types of loans is usually pretty long, certainly longer than a pure. I used to work at a bank called Macquarie. They're like a leader in project financing for small gold mines. ECA debt facilities are different from those types of debt facilities. They're longer in tenor, and the interest rates are quite attractive. So Berg is well positioned for that. The second category I would point people to is like JV off-taker type relationships, and so this is going to depend, of course, on who's completing this work, who's financing this stuff, and M&A is obviously an overlay to that. So I hope people can kind of see what I mean there. It's like we're not going to rush out and jam a JV partner in this prematurely. We have to be cognizant of how the M&A opportunity set looks for us, and so there's kind of a logical way to go about that. But suffice to say, this is a project that would have very comparable positioning and appeal to, look at what Hudbay did with the Copper World asset just last year. So they sold 30% of the Copper World project to Mitsubishi for $600 million US dollars. That those proceeds are usable by Hudbay for their capital contribution, and Mitsubishi will come in as well for their pro rata. So they're buying the equity, and then they have to contribute pro rata to the equity component. So that's a very logical thing to do, especially if one of those groups is bargaining for a big offtake position, et cetera. We'll have the copper and the moly to be looking at with respect to that. I think there's interesting avenues to explore there on both fronts. And then the last piece is the silver stream. So we got a nice slide in our deck that shows where the silver production profile from Berg would rank against all global copper mines that produce, above 1 million ounces silver. And it's a top 15 silver producing copper mine. So it's a bit of a niche category, but the point is that precious metal streaming is a really basic and well-trodden area for how these mines are financed. And the theoretical silver stream from Berg would be large enough that it should be on the radar of all the big mine finance groups. And if you apply very basic assumptions to that stream at the right time, like, this is something that would be put in place in very close proximity to an investment decision, one could come up with numbers, and it's reasonable to expect that that silver stream could garner, $1 billion to $2 billion in value for the project if a stream was sold under optimal conditions. So again, you can whittle down this capital cost to a very reasonable number. If the entity that was bringing it forward, be it SURG or some combination of medium-sized enterprises, was needing to contend with that. At this stage, though, our like positioning of the project is, I don't think there's any like reason for us to be positioning it from a capital constrained mentality. Our perspective is, again, stepping back to what I just said about the fact that why do we like this thing? The fact that this is a big copper project in Canada, like one of the biggest, and it's got a straightforward development path. To me, that implies that there will be entities out there who do not face financial constraints who will have a very close look at this. So it behooves us to put forward a development case that maximizes returns on capital for capital unconstrained counterparties. That doesn't mean that there aren't embedded options in the project for capital constrained parties to look at pathways for development, and that could be tweaking things around phasing. It could be tweaking things around, how aggressively you develop the mine, and we can get into the numbers around all that. But yeah, the capital cost scenario or development scenario that we put forward is not a unique solution. It is just one solution that solves for what we consider to be a prudent, robust development scenario that delivers really excellent returns on that capital.
I definitely want to talk about different development potential scenarios that you might want to implement in the EFS or not. I definitely want to talk about that. You mentioned something about the off-takers that makes me think about the byproducts here, essentially, right? And obviously, moly is the elephant in the room here, as you mentioned. With how volatile moly prices have been over the last couple of years, does the fact that about 30% of the gross revenue comes from moly, and that's at $20, does that concern you?
No, not at all. I mean, I'm a bull on moly for one. I've studied it a lot over the last few years for good reason. So I'll speak to that in a second. But just to answer your question, like the project is just resilient to that, anyways. You can stress test it to very punitive levels of moly prices, and it doesn't materially impact the economics. So in the disclosure for the PFS in our corporate presentation, we show pretty standard tables of NPV and IRR sensitivity to copper and moly prices going up or down 60%. So you can look at the negative 60% case for moly at base case copper prices, and the thing is still like an 18% IRR and multi-billion-dollar NPV. And of course, our long-term copper price assumptions, I think, are fairly conservative. If you're a copper bull and you want to look at $5, $6 cases there, and then you stress test the moly there to $8 per pound, you're sort of right back to our base case numbers. So it would be a concern if $10 moly price decks here resulted in a sub-economic project, negative NPVs, sub 8% IRRs. Like, sure, that'd be a concern, but that's just not the case. If copper collapses to $3, sure, that's what you're dealing with, but it's perfectly robust to a wide range of moly prices. And just to give folks a sense on that stress testing, the spot price for moly right now, I believe, is like $35 or $40 per pound. It hasn't traded below $20 per pound in the last few years. And when I say stress test to $8, I'm not talking about like a blip. I'm saying 30 years of flat $8 per pound. Like it's really hard to imagine that being a like a plausible scenario. So that in my opinion is an aggressive stress test, and the project stands up perfectly fine to it. On the flip side, like what's our view on moly? I think it's an interesting area, and I've seen increasing interest expressed to us from metal trading outfits and industrial end users alike. So I think it's a sector that is like there's a whole lot of secular demand coming to the fore there, and it's a similar story to the copper, to be honest. Like lots of different demand cases that are in growth, and the supply side remains quite uncertain. The important thing to understand about the supply is it's a big market. It's like 600 plus million pounds per year. The largest mine in the world would constitute, the largest producer in the world would constitute like 5% of the market. So it's not a very concentrated market. It's very different from other critical mineral minor element type markets where you got one or two mines there's like a lot of mine level risk. That doesn't apply in moly. It's a very, very broadly supplied market, but there's a geographic overlay to that. So half of the world's production comes from a lot of these big primary moly producers in China. They're porphyry deposits, but they're just like pure moly. So molybdenite porphyries. And so they provide, or they supply roughly half the market. And so people have memories of the moly market being volatile, and usually that's about whether or not China is importing or exporting. And so, as we all know, that a lot of that is not just pure free market economics. There's a lot of like trade policy overlays there, and so I think when you look at the moly market, the thing to keep in mind is, it's currently under export restrictions from China, but more broadly, this would fit into the overall thematic that a lot of areas of the global economy are contending with right now, which is polarization of the world. So molybdenum is a very useful material. It's essential in all kinds of high performance steel applications. It's a big enough market that steelmakers will go to moly before they go to tungsten and niobium and rhenium for different things because of its abundance. So it's a very like useful and valuable material. And I think there's a very tangible, logical basis for long-term users of this metal to not want to be reliant on Chinese suppliers. So we think it's a really interesting strategic area for us because what we can position to people is, hey, this is actually a top 10 moly producer globally, but it's not a primary moly mine. So if the moly price does collapse for 4 or 5 years in a row, we'll just keep humming. It's not going to, render this thing in negative cash flow because it's a byproduct producer, but it's a big byproduct producer in a safe jurisdiction. Like that's valuable to a lot of end users. Look, I'll point to another. There aren't a lot of moly competitors out there, but one of them that inked a pretty interesting deal is Almonty. So they've got a Korean tungsten mine. Got a like separate moly zone that they're also developing in parallel. It's kind of a non-core thing for them. So they went ahead and signed like a life of mine offtake agreement with a Korean moly smelter, a Korean steel company called SIA. And that offtake contract had a $19 per pound floor price. And I think on the back end of that, SIA entered into a long-term supply agreement for refined molybdenum products to SpaceX for like, I don't know, decades. And so it just kind of gives you a flavor. There's a lot of end users for molybdenum that are, critical industries, whether you're talking about defense or aerospace or, energy or chip fabs. These are industries that, need access to this material. They're not necessarily concerned about it not being available, but they are a little bit worried about the China nexus. And so I think a project like Berg is in a very strong position to be able to, at the appropriate time, with appropriate due consideration paid to project financing and other factors, we're in a good position to be able to enter into, I think, really interesting conversations with some of those strategic counterparties. So again, answer to your question is not worried about the price. I think the long-term price assumption we made was conservative, and we see the strategic positioning of our moly production profile as being a net additive to the project.
That's something else that I was wondering as well is do miners care about it as much as they would for, a precious metals stream or byproduct or whatever they might have? So what would, like, if this was 30%, if 30% of the value is coming from gold, would this asset be more valuable to a potential producer is what I'm wondering here? Because in the end, cash flow is cash flow, but there is a difference between moly and gold, of course.
Yeah, it's a good question. I think that the answer to that question, if you had posed it for equity investors, I would quickly answer that as like, oh yeah, for sure, equity investors would be all over SURG if it was a copper gold thing with a identical NSR profile. So that's probably a real thing that we contend with. But on the strategic side, I don't know. I mean, gold is like just a deep market. I think people view it as like fungible. It's just basically cash. It's volatile, like any currency. So I think a lot of strategics don't have deep conviction over long-term gold prices because, like, how do you forecast that? But it's like there's no concerns about selling it. It's just like a infinitely deep market. If you're producing it, you're going to get paid for it and whatever. So people view it as a really liquid byproduct credit in that regard. I would say the moly piece, it's changing for sure for the strategic reasons I've just outlined. I would say 10 or 20 years ago, you didn't really see like the Glencores or the Traffies of the world's involved in that market for the whole like China dimension. I think it was just viewed as like an opaque market. It was big. It's always been fairly big. So it's a big market, but like what China is doing, whether they're inhaling or exhaling, is a bit of there's like opacity there. So what's changed in recent years? Well, for one, I think the demand picture has improved. I just think the criticality of this as an input ingredient to all sorts of things is much clearer. And I think there's just the secular uptake of adding moly to all sorts of steels is becoming clearer. So I think people are really comfortable with the demand side of the picture there. And yeah, the concern about like, oh, what it's a global the globalized world, free trade, open borders, China could at any point dump on us and we have no visibility there. That was definitely the prevailing wisdom. That was the prevailing wisdom 10 years ago. I just don't think that applies anymore.
So yeah, this gives me a better idea of even how off-takers might think or potential strategic might think. And I guess we spent about an hour actually thinking or talking about how other people view this thing and how you view it as well. Let's talk a little bit about the specifics here. And I will go back to that Capex because I see that the LOM average copper output is 176 million pounds per year on an equivalent basis. Again, $4.7 billion Capex. Compared to some of the other PFSs that I've seen recently, I'd expect, if someone told me, oh, this is 176, like 120,000 tons on an equivalent basis, so sub 100, I think, on a copper only basis, I would expect maybe a billion and a half, maybe up to $2 billion in Capex. What's really driving the Capex here? Why am I seeing other stuff coming up with, $1.2 billion Capex? As opposed to you having that high of a Capex? What's really driving that number?
So look, I mean, we did a fair bit of benchmarking in the latter stages of this work. Like, obviously, the cost estimates are bottoms up, so they're like first principles on the specifics of the project. But then it's worth you sense check those against other things and. For the right comparative universe, the capital intensity, the aggregate capital costs here are not out of line. So what that right comparative universe would be is other projects of a comparable scale, so greater than 100,000 tons per annum of copper equivalent output for multi-decades, porphyry style mines, so 100 and comparable mill size, 120,000 tons per day, et cetera. And then recent capital costs. So, one of our obvious competitors in Canada is the Casino project. It's in the Yukon. Like, it's got a similar size and profile. I think their mill is also 120,000 tons per day. But look, their feasibility study is from 2022, so it goes without saying you can't really treat those apples to apples. So when we benchmark, we're like looking at stuff that's like recent. So for us, that was Warintza, Taka Taka, Yellowhead, Vicuña, Phase 1, Eva. We even looked at non-copper things like the Canada Nickel project. The name is escaping me. Crawford. They're in FEED, so they're like kind of late stage engineering. So we looked at a bunch of those things and benchmarked against it, and I think it lines up quite well. On the specifics, like what's driving it, I think there's a lot of important points to discuss and explore there. So this is a project that, it's got a few basic components. It's a big mine. It's got some on-site infrastructure to move material around, conveyors essentially, and it's got a process plant, and it's got a tailings facility. So there's a lot of earthworks related to that. And then there's off-site infrastructure, which for us is primarily a power line. There's a little bit of road development, but it's quite trivial. The power line, in contrast, has it's a bigger number in the capital costs. So when you think about the where there's flexibility, where those numbers come from, the size of the project, both in terms of the size of the plant, like you make a decision on the throughput of the plant that tells you how many SAG mills you need and what the size of them are, tells you the footprint of the mill and how much steel and concrete go into it, all those sorts of things. There's not a lot of magic to that. It's like you pick some numbers and you estimate the costs. And same thing with the tailings facility and the infrastructure. It's like the amount of tons coming out of a mine like this will tell you what the conveyors need to be, and what the tailings solution. I guess that's there's different projects will have different needs based on their tailings design. In our case, the tailings dam the tailings volume to dam volume, like construction material volume ratio is really attractive. So I like there's no issues there. It's a pretty attractive option. But again, it's the overall size of the project that's determining that. And same thing with power. Like there's what the installed power requirements are. Not a lot of flexibility there. Where there is a lot of choice and flexibility is on mine capital. So in our case, out of the 4.7 billion Capex number, which is both indirect and both direct and indirect, so that includes like a pretty big contingency number in there. But the direct mining Capex costs are 1.7 billion. So it's like a significant component to it. And what that is, like the vast majority of that is like activity. It's like buying fleet vehicles and mining a whole bunch of stuff in the pre-production phase. And so that is intimately connected to strategy and like how you're developing the mine and whether you're solving. So I kind of went through this earlier in this conversation, like what are you solving for? What are you prioritizing? So it is the ore body itself, the project itself has embedded in it the optionality to, if your priority was reducing upfront capital, you could definitely solve for that, but you will have the production profile is going to look different. You will not be able to access the same blocks in the block model in the same sequence as what we have put forward. And so it maybe will be lower capital costs, but less efficient, like lower returns on capital. So we very explicitly made a decision, which was like, look, this is a 3-year production period. We're going to buy the entire fleet in the first 2 years, and we're going to mine 350 million tons over that 3-year period. developing a large stockpile and fully opening up the mine so that in year 4, when you're commissioning this 120,000 ton per day concentrator, you're not worried about feed into the mill. It's like it's already there and the mine is humming. It's all running tickety boo. And so that's a pretty, I think, defensible, conservative assumption. The comparative to that would be if you're saying like we're financially constrained, we want to lower the upfront capital costs. We're not going to start buying the fleet until like we have to. So we'll buy a couple trucks in the first year, and then 80% of them in year 3, and then we're going to be like rushing our tails to get the mine ramped up, and then overlapping that with commissioning. There's plenty of studies that contemplate that. That's not what we've done here. So the mine capex is fully loaded. There's also no fleet finance. You can fleet finance, but again, here it would produce suboptimal returns because you'd be paying for half of the lease term during the pre-revenue period. So you're like borrowing money to pay interest twice. It wouldn't really make a lot of sense. But again, if you're solving for a different thing, if you're solving for reducing upfront capital, that's a big lever to pull. You could lease finance a huge number here, $800 million or something for the fleet. So we think the capital cost proposition here, it's tailored for an owner-operated, financially unconstrained scenario. And the concept of it is prepare the mine so that the grade, like the metal units moving through the mill in the early years, is maximized in order to maximize returns on capital, minimize payback period, and so forth. So this is it's a very financially rational development plan. It's not the unique solution. It's not the only development plan. There's other options that are embedded in it, inclusive of like phasing, right? So in our trade-off work, we looked at phasing, like 60,000 tons per day, produce some cash flow, expand to 120,000 tons per day a few years on. You can absolutely do it. It's just not as, it produces like worse IRRs than what we're putting forward here. But it's all about what the entity that's making the investment decision, what their constraints are and what they're solving for. And I think for us at this stage of the game, that is unknown. We think it makes sense to profile this asset for a broad, financially unconstrained audience and highlight what the ore body is capable of doing on a return on capital basis. And I think that case looks quite good. It's very, very, very conservative from an operability perspective, very conservative from a capital cost perspective, and delivers superior base case returns to other things that have been put out into the market recently of a comparable scale.
Well, what you're talking about here essentially, or what you were talking about just before now, was the first 5 years average 270 million pounds of copper annually, while the LOM average is 176 million pounds. How much is this kind of front end weighting, if we can call it that, which it is, I guess? How much does that rely on higher grade material being mined early? And where I'm going with that is thinking about what happens to the overall economics if that sequencing, doesn't go as planned, which it often does in mining.
Yeah, I mean, it's very explicit, right? I think this is like a financially rational thing to do. Like this is the when you're doing mine optimization in an open pit, it's a physical problem that you're solving, in the sense that you can't mine a block in an open pit unless all the blocks above it in a cone shape have been removed. Like that goes without saying. You can't selectively mine stuff in the middle of the ore deposit before stuff above it. So that's your primary physical constraint, is that you're moving top down. And there's all kinds of operability things about pit slopes and ramp progression, and those are like the physical constraints. But the goal that you're solving for is up to you. It's like it's strategic in nature. It's like, do you want to have a smooth production profile? Do you want to minimize capex and have the thing produce a lot of internal cash generation to feed ongoing investment? Or do you want to do what we've done, which is one and done capital? That's all front end loaded. and then produces a whole bunch of free cash flow early on, pays back that capital, and then is like free cash flow, smooth sailing with pretty high margins for 28 plus years thereafter. I think the case we put forward is a logical and compelling one, and what that depends on is exactly what you say. It's all about explicitly looking for the best grades that can be delivered to the mill early on, and what's required to provide access to those grades, which is pre-stripping and just preparing the mine for that kind of path through the ore body. So that's it. Yeah, it's just like delivering solid grades and throughput. So I think like early in the mine life, it's softer ore. So the limiting factor is not just some arbitrary number of what the mill throughput max is. It's like its power consumption, and so softer ore will flow through there quicker. So I think we have the max throughput when most of the feed is supergene material it goes up from 120 to close to 130. So it's those sorts of dynamics. It's just like grade and softness of ore is what's driving some of those early production numbers, which are impressive. You got like within the first 5 years of the operation, you're producing $6 billion in free cash flow. So that's on purpose.
Yeah. This also makes me think about, because this is not it actually. I mean, a meaningful portion of the inferred resource sits inside the ultimate pit shell, and it's treated as waste in this PFS. Yep. So what percentage of that material could you convert through the drilling that's going to be happening this year, and what would that do to economics?
Yeah, exactly. So we've got 1.2 billion tons in reserve, which is contained within a 1.4 billion ton measured and indicated resource. And then on top of that, you've got a 1 billion ton inferred resource. So reserves, by definition, must come from measured and indicated classed resources. So the incremental M&I resources that weren't converted into reserves, by definition, they're outside of the reserve pit volume. They're like deeper than the reserve pit. The inferred resources could be anywhere, right? The reason they're like not considered is because of their classification. So we put a note in the press release that there's 200 million tons of the billion tons, so 20% of that material is inside of the reserve pit volume. So it's just sitting there waiting for a few additional drill holes in the right location to bump up that class to M&I, and then it would likely fall into the reserve plan. Of course, contingent on the grade meeting or exceeding what the inferred grade estimate is. So with that caveat, all it needs is successful drilling to kind of change the category there. And then the other 800 million tons of reserves and 200 million tons of M&I resources, again, totaling a billion tons, sits below the sits below the reserve pit. The pit optimizer will be blind to the inferred material there. So even if there's some good M&I material, it treats it as like little pockets sitting within a sea of waste. And so it won't obviously put a pit around it to capture that. Whereas if you convert all of the inferred material successfully, subject to that caveat that you got to drill it off and hit the right stuff. But if you convert all that inferred material to M&I, absolutely, I think there's the pit could and would go deeper. So I think in the fullness of time, with more inferred conversion drilling, you can expect that the mine life here at a 120,000 ton per day throughput will extend from 28 years to something higher than that. So I think that's a low risk proposition. And for what it's worth, the Berg deposit is unbounded at depth. So we've drilled some deep holes there. They all end in mineralization. I think you could probably put a kilometer plus long hole right down the middle of this thing, and it would be average resource grade from top to bottom. So 0.22 copper, 300 ppm moly, 4 grams silver, a little bit of gold from top to bottom. So the constraint at the end of the day is open pit mineability. So we haven't seen evidence for, caveable type grades at depth. That's blue sky optionality. Maybe a super deep drill hole hits that at some point, but yeah, I think the prospect for the ultimate reserve pit growing over time is very tangible. Of course, what that means is mine life extension, so its impact on NPV and IRR is very modest because you're talking 30 years out.
Yep. But it's basically a lot of the models, like when you run a DCF on a mine, it's I'm not going to go into a rant, but a lot of the stuff that comes after 20 years is virtually worthless.
Yeah, that's what. Yeah, again, so it depends on what you care about. Like there are some companies that are. Look, I think an interesting comparison is Vicuña, like different scale. Like that's a big project. Like the amounts of metal coming out of that are very different, but the shape of the production profile is kind of the opposite of what we're talking about. So I'm here making a case that a non-phased, one and done project that produces like the highest metal units in the early years is a good thing. It produces like really rapid payback and a lot of free cash flow. It's like a good business proposition. Vicuña is like a strategically slightly different approach. It's like it's big. The capital costs are already like quite big, and so the shape of the production profile there is kind of the opposite of ours. It's like it starts the smallest year it'll ever have is year number one, and every year it gets bigger and bigger and bigger and bigger because every little bit of operating cash flow they produce in the study gets redeployed into growth and expansion capital, and so it doesn't produce its full free cash flow potential for a long time. It's a super long dated, long duration asset, and its owner loves that. I'm sure. Like both BHP and Lundin are very long term thinkers. Like their view is, 20 billion in free cash flow 20 years from now is fine by me because we're going to be around to be making smart, compounding decisions at that time. So it's just different things that you're solving for. Right?
Yeah, fair enough. Let's maybe walk through some of the basic operation metrics here and see how sensitive the project is to them and also to what you might be adding through some of that drilling this year. I'll start off with strip ratio. How sensitive are the economics to a higher strip ratio than what you've modeled here?
I can't quote you an actual number. Let's see here. I mean, I'll give you a sense of just OPEX sensitivity. So strip ratio, of course, goes to mining OPEX. So the higher the strip ratio, the higher the operating costs because you're just moving more waste per ton milled. So in our sensitivity analysis for the PFS, we certainly have OPEX sensitivity. Strip ratio sensitivity is not something that can be like directly modeled per se because the block model is the block model, right? Like I don't think we're looking at a dynamic situation of like is the block model changing dynamically? It kind of gets set in stone, but OPEX sensitivity will be a more blunt measurement of that because waste movement will be a subset of total OPEX. So if I say 10% change in OPEX, that's obviously that's a larger change than a 10% increase in total waste movement, if you follow. Mm-hmm. So a 10% increase in OPEX would change the base case economics from 4.6 billion NPV to 4.1 billion NPV. And the IRR from 24% to 22%. And for what it's worth, one incremental step up from that 20% increase in OPEX, NPV would go to 3.6 billion NPV. These are, of course, base case metal price numbers, 3.6 billion NPV and 21% IRR. So I'd categorize that as pretty normal sensitivity to that particular factor, OPEX, and obviously quite robust.
Well, you already have I think about 300 million tons of pre-stripping. So that's really where I'm thinking why I wanted to start off with the strip ratio because I'm thinking also about flatter flatter pit slopes and what happens to those early stage economics that you were talking about earlier. They're quite an advantage here. What happens to those economics if your pit slopes come in flatter, essentially.
I see what you're saying. So, yeah.
It's
So
good that you see
if
what I'm saying because I don't always.
yeah, yeah, like what you're saying is like is the actual mine plan that is contained in this study is the regardless of what the end of mine life strip ratio is, are the pit slope angles like is the first phase if that proves to be too aggressive and even more material needs to be mined early
Yeah.
on,
Yep.
like what's the sensitivity there? Again, I don't have a dynamic sort of answer for you on that, but yeah, like the mine, the the way in which the engineering for that is done is kind of encapsulates all that. So there's a whole bunch of like geotechnical assumptions based on lithology that go into the mine planning. And then there is like operability considerations around where ramps need to be, how they get developed, so on and so forth. And those are the constraints that are applied against a desired kind of path through the ore body. So if you know that you want to get this grade over in this sector of the deposit in the first few years, and then you want to move over to this area to get that grade in the years 4 and 5, how does the deposit need to be developed to account for that? So that's kind of the phasing, and so the development of the mine in that plan will account for all of our geotechnical knowledge and operability constraints around ramp development and so forth. So it's certainly not like thumb sucking back of the envelope, like put a 45-degree pit slope here. It is like supportable first principles engineering around those kind of key considerations. So obviously, if in the context of more engineering work, maybe requiring more conservative assumptions around that. I mean, yeah, I suppose you could see more tonnage needing to be mined, and on an apples to apples basis, that would require the Capex for that work to go up. But as I said before, like the mine plan here is not the unique solution. It's one of many. So if that's something that was discovered, the ore body holds all the optionality for us to go about it in a different way. And more information could cause the optimized solution to look different. But I mean, the big picture point here is there is a lot of flexibility in how an open pit is developed, and we've put forward a case that produces pretty solid returns, even with quite conservative development assumptions around mining and the attendant capital costs.
That's all tying actually into your cutoff grade as well, because this is on a copper basis alone. It's not a high grade deposit, so it's 0.2 ish, call it. If costs come in higher than expected at first due to potentially some of these things, you might have to raise the economic cutoff. Do you expect that to be the case? Do you expect higher cutoff for the FS, or is it kind of set in stone here? No pun intended.
Yeah, so a reserve cutoff is we do it on an NSR basis, of course, and the reserve cutoffs for the block model are it's like a bit of a different thing than the economic analysis of the NPV and IRR that goes into the mine plan, but you certainly do have a in the course of running like a pit optimizer, you choose an NSR cutoff, and each block is sort of measured. Is it above or below this NSR cutoff based on a particular formula? And yeah, the NSR calculation for any particular block of material is a snapshot in time because it involves a whole bunch of economic market factors in addition to technical factors. So the technical factors, the physical factors are grade and recovery. The market factors that you're applying to that are, of course, metal prices, but also a whole bunch of cost assumptions around mining costs, processing costs, and refining, TCRCs, things like that. Mm-hmm. So, So over time, reserve models, resource models are dynamic in reality. So those things certainly can change. So this project, like any other project, whenever you're making investment decisions, it's a lot of, you have the life of mine concept. But of course, the further out you go in time, the more uncertainty there is between where prevailing metal prices are going to be and where the cost structure of these things are going to be. So, that's just a truism, but it also points to rapid payback being a virtue in these things, right? Like if you're going to make an investment decision for billions of dollars, all else equal, you'd rather recoup that capital in a couple of years as opposed to 10 years because you embed more. I mean, like literally default risk, bankruptcy risk if you're waiting around 10 years to get paid back,
Dilution and mining recovery matters here as well. Obviously, at 0.22, I believe, is the copper reserve grade. Essentially, dilution could hit pretty hard. How's dilution modeled? How sensitive is Berg specifically to mining dilution?
Yeah, so in an open pit, I think mining dilution in an open pit is like just less of an urgent factor than in underground mining for just kind of basic geometric reasons. So really, what it amounts to in an open pit mine is just kind of understanding in 3D space of where the boundary is between ore and waste. And so obviously you've got a block model for that, but when it comes down to mining, it's grade control drilling. So it's like a resource and reserve block model is, I mean, these estimates are intended to be, and there's all kinds of geostats to help you understand like how robust they are. But they certainly at the kind of granular, when you get down to the actual bench scale, you're going to deal with higher degrees of reconciliation risk and volatility there, and that's where grade control drilling comes into the picture. And I think the benefit with open pits is like grade control drilling and blast hole drilling they often overlap in a big way. So yeah, typically by the time you're like planning, like I'm not a mining engineer or a mine operating guy, but I think this is just kind of basic knowledge that by the time you're mining a particular bench or face in an open pit mine, you've got like very real-time data on what that is and what your kind of dynamic cutoff is. So usually at this stage for like a life of mine pre-feasibility type study, you make sort of reasonable assumptions on dilution that are like that should account for just like human error in that. Just the fact that you're loading huge trucks with like a bunch of material, and you might kind of pass that like surface cutoff between, or that surface threshold between what is ore and what is waste, and a little bit of waste might end up in the wrong truck and so forth. So you end up with like single digit percents of dilution. But it's prudent to make sure that you're making an assumption there that isn't zero, because it will never be zero. So we have made such a prudent assumption, but I don't think mining dilution risk is a huge concern for these types of ore bodies that are just big, broad zones of like stockwork veining. It's like you kind of know when you're in the ore zone or not visually, and grade control drilling will give you a crisper edge knowledge of that in operating practice.
Are recoveries, so metallurgical recoveries, is that a risk in these type of ore bodies?
I would say for the Berg deposit, we're pretty confident about that. I think it's a big feather in our cap. So I'll just maybe monologue on that for a second. So there's a porphyry copper deposit. You've got primarily hypogene mineralization. So the vast majority of the reserve life is hypogene mineralization. So kind of like the primary sulfide stuff that was put in place. You do have a little bit of a weathering enrichment feature at the top. So a supergene enrichment zone that has converted some of that to chalcocite. So It's all sulfide. There's very little oxides in that supergene zone, and those oxides obviously won't float. So you do lose a little bit of recovery in terms of total copper content, but it's more than made up for by the copper enrichment that you get from that weathering supergene phenomenon. So you got like a whole bunch of effectively chalcopyrite and chalcocite, two copper minerals that float very well, and then the molybdenum. The molybdenum kind of like vein set here is like totally distinct in time. It's like a separate thing. And we have a slide in our deck that shows the kind of cartoon geological model. The copper stockwork veining is pretty much everywhere. It's like very homogeneous. The molybdenite veining is slightly more like structurally controlled or zoned. So you have like a central intrusive plug in the middle, which is called the Berg stock. It's weakly mineralized, and then the country rock around, which that intrusion was intruded into, is where most of the stockwork veining was developed. And the molybdenite veining is highest right at that contact, and it's not like a thin vein. It's like I'm talking about like 100-meter zone. So I've kind of just described it to some people as like you can think of the whole deposit as like a beer can or soda can, where it's like this big cylindrical thing, and think of it as like a super thick walled beer can. So big cylinder with a pretty thick walls, and like a what do you call it? Like a coulis, like a insulating sleeve around it. So the insulating sleeve is like the copper. It's thicker, it kind of goes everywhere, and then you got a thinner thing on the inside, which is the moly system. My little visual analogy there is I got to work on that because it conjures a very thin band, whereas in fact the zones here are like hundreds of meters wide. So it's not quite like that, but the point is that if you're right in the guts of that molybdenum vein set, like close to the contact with that central intrusive stock, moly grades get really high. Like we've put out some interesting drill results from that in recent years, where you see moly grades like upward of like 1,000 ppm in some places. So it's quite impressive. But importantly, the key point here is that the molybdenite is like emplaced separately. The minerals are totally different. They're not like no encapsulation or any sort of mineral level physical challenges to separating them. And so from a flow sheet perspective, you are grinding everything down to 160 microns, which is pretty simple. Like it's not a overly fine grind size. You float everything to a bulk con. Everything floats very well to that. Hundreds and hundreds of tests have been done to that effect. And then then there's a moly separation stage. So sorry, there's cleaning stages. So the bulk con gets cleaned. So you're trying to remove all the pyrite and things like that. And in the course of removing the pyrite, that's where you tend to get losses of some precious metals, which is why most copper porphyry deposits will have precious metal recoveries of closer to 50 than 100 in most cases. It's because they're optimized for floating the sulfides, and only some of the precious metals are going to be associated with or kind of attached to the sulfides. So it's when you're cleaning the sulfides that you don't want, you lose a lot of the precious metals, and then there's a moly separation stage, which is like you have a much smaller volume of material. You're talking about just the bulk concentrate. It's usually like a mass pull of a few percent. So you're talking about like a few percent of the total feedstock is now containing all the metals, and you do a preferential float of just the molybdenite minerals, which is it's straightforward. It's how 90% of these copper mines around the world work. There's always a little bit of tweaking to get the behavior exactly the way you want, but there's no kind of fundamental scary risks to that at all. And the key selling point for us is that the flow sheet doesn't change throughout the mine life. So, commissioning always takes a little while for these things. There's always ramp up hiccups to get out of the way. But the benefit here is you're commissioning this mill once, and then you got a pretty homogeneous, feedstock coming in for decades. So should be pretty low risk from that perspective. There are other copper projects out there where that is not the case. Like they're flipping from a SXEW leach circuit. Maybe they're trying to leach some of the gold out of the concentrate itself, or the rougher tails, and then they're introducing a moly separation circuit later on. So they're effectively commissioning like 3 or 4 different circuits over a 20-year mine life. Goes without saying that's riskier, right?
Yeah. Are there any areas of the deposit where the current drilling density or just your geological understanding overall still carries a material risk to the mine plan that you've presented at the PFS versus the mine plan that is actually going to be in your FS or even in reality eventually?
No, I mean, not something that we're losing sleep over. I mean, there's always more data to gather, but I mean this is a porphyry deposit, which is like, these things are just like the continuity in three-dimensional space for these things is typically pretty high, right? Like we're not dealing with nuggety gold and sort of discrete structurally controlled systems. It's like pretty it's just like stockwork veining, pervasively developed in large lithological units. And our drilling, the drilling of the deposit just bears this out. You can just drill, long intervals of pretty consistent grade. There's always room for upside. Like, we are drilling into the nether regions of the deposit now as part of our geotechnical and geochemical work. Geochemical work is really about characterizing waste rock. So you're drilling into the waste rock. So I'm sure there's going to be interesting little silver veins that we'll find around there, which are nice little surprises. So there's always more to learn, but no, we're not. I don't think there's a lot of concern about resource estimation for a deposit like this.
Well, I've tried to pretend that I know what I'm asking here for at least the last hour, probably even longer than that. So it might make sense to move on from that part and talk a little bit about some of the stuff that I do understand, at least a little bit of timeline. What's the timeline, and specifically on the permitting side here, what's the timeline for your full EA? When do you think you can get it? Again, specifically thinking about it, it's normally like a normal question, but then because this is BC, I'm kind of more curious when asking it. So, or more cautious, I mean, when asking it. So, yeah, what's the timeline for a full EA?
Yeah, I mean, it's impossible to give a definitive answer for obvious reasons, but I will tell you that we are positioned well to enter that process in a formal capacity later this year. So as early as August, we're taking steps, going through steps right now to prepare for filing the document that constitutes the start of that process. So we will be like in the EA process later this year. So that will provide a little bit more certainty around all that kind of stuff. I will say that the timeline to completing an environmental assessment and kind of parallel permitting in BC is a very dynamic area of discussion right now. The track record over the last 20 years has been variable for sure. I think for a mine of this scale, it would, we would, normally be bracing for a fairly long period of time. Does that mean it's different from other places in the world? Not necessarily. I think the timeline to permit a mine of this scale in lots of different jurisdictions around the world that are of interest will be comparable. So I'll state that as a kind of background point. For what we're dealing with, though, there's quite a lot of nuance there. So we intend to be entering the environmental assessment process in British Columbia as it's currently configured, and there's I think a lot of efforts being made within that regulatory apparatus or regulatory system to improve realized timelines. So lots of stuff generally under the category of permitting transformation. Our VP of Environment and Regulatory Affairs, Jen Anthony, is she's been an architect of some of that stuff in her prior job with the BC government. So we know a lot about what they're after and what the different levers are that you can pull to try and achieve better timelines. So we think in that kind of basic system, somewhere like a 3 to 5 year timeline is probably prudent for planning purposes to think about how long it will take to get through assessment and permitting. I will say that there is like newly created or in the process of being created different pathways in British Columbia and elsewhere in Canada for that matter for expedited permitting processes. So there's been some laws that have been passed that create new legal frameworks for specially designated projects to go through expedited pathways. There's a lot of caveats to all that stuff, but for what it's worth, they are targeting timelines of as low as 2 years for those sort of situations. So, we're not trying to, promise anything or anchor anybody on that sort of expectation, but goes without saying that the Berg copper project, because of its critical minerals profile, is, potentially one of the projects in BC that could be considered for something like that. Doesn't even necessarily mean that we as the proponent would want that. There's all kinds of risk trade-offs and so forth. But I think anywhere from like 2 years on the absolute low end to maybe, as I said, 3, 4, 5 years for the traditional process is the right way to think about how long it takes to bring something like this through that regulatory path. And then the other business aspects that go alongside that is advancing the project to feasibility and sort of de-risking a lot of the commercial aspects, which is offtake agreements and project finance and team building and all those sorts of things. And again, very simplistically, I think the timeline for permitting will be longer than those other things. So that will be the like limiting factor, the critical path. And those other business aspects will flow alongside that and be responsive to lessons that are learned from environmental assessment, which could amount to like little design changes here and there, which you need to incorporate into feasibility and so on. So that's the path forward. We view the company as being well prepared to embark on that journey. We have certainly adequate funding in place for the first couple of years of that, and I think I talked about this warrant in place earlier, so that can deliver additional funds to the treasury in due course to really bolster our path forward.
What kind of work is left to be done, or what kind of data would you need on the environmental side? What else? What else needs to happen here?
Yeah, it's a range of things. So our field program this summer will be taking a big chunk out of what's needed for feasibility. So it's a lot of geotech drilling, geochemical waste rock characterization drilling, hydrogeological drilling, continued environmental baseline studies. So that's water quantity and quality, and mapping fish habitat and putting sensors out in the trees to record what sort of birds are around, and using AI models to collect all that kind of data. It's pretty interesting stuff, and there's lots of like new forms of science that are kind of coming into that work that we're doing. So it's great stuff. I was alluding to this before, like the total meterage of drilling, which will be like the biggest cost center for that work, is not crazy. Like I think this year, as an example, order of magnitude, we're looking at maybe 6,000 to 8,000 meters. And again, that's because we are sitting on 1.2 billion tons of reserves with that resource model pretty well de-risked. Always more to do there, but it's not an urgent priority. And so a lot of the drilling requirements are focused on a geotechnical characterization of a footprint where the depth of that drilling is 100 meters per hole, and geotechnical characterization of a single pit where we're not needing to put thousands of pierce points through the final pit limits there. It's just a fundamentally simpler situation than that. We don't need to drive a decline or take bulk samples or anything like that. So the cost journey to de-risking this thing technically is pretty manageable.
Was some of the work or some of the assumptions taken in the PFS better set, was any of that done with the kind of the environmental EA in mind? Like, is there something you did that you wouldn't have done? Yeah, go ahead.
Yeah, no, it's holistically, I think a lot of assumptions in the design of the project are geared towards striking the right balance between good economics and reducing risk around permitting and reducing risk around timelines, for sure. So, like the power supply option is a good example of that. There's a number of different ways to tie into the BC grid around here, and we went with an option that probably isn't the cheapest, but is the lowest risk from a permitting perspective. It uses an existing linear, huge road that's already in place with a power line on it already as the pathway or the corridor through which the power line will be developed. So that reduces a whole bunch of risk around permitting, but also executing on that. The costs around doing so are minimized. The baseline work around that is positively impacted from that. So that's kind of one classic example of that. But yeah, I mean, even the decision to have the overall layout of the site with the process plant and camp facilities and everything at low elevation, those are all things that are low, like they reduce risk from both just permitting and operations perspective. So lots of thought went into that, lots of emphasis so when the technical report is filed, an important chapter that I always look at in these things is recommendations. So there's a lot of thought that goes into what needs to be done from here to the next milestone. And we've put a lot of effort into just very carefully thinking through that stuff and planning our work to deliver that. And we did the same from PEA to PFS. So we're pretty proud to have advanced this project the way we did at the costs that we did over the last few years. And that is testament to, that type of kind of planning and thought process around things.
There's also when you think about the EA, there's also the First Nations thing that we discussed a little bit earlier and how they reacted to the PFS and whatnot. There's also this thing in BC where sometimes more groups would come out of not out of nowhere, but there would be more groups coming out of coming to lay a claim, essentially be like, oh, there's going to be a power line crossing my land or something like that. Groups that you might not have accounted for before. Has that happened yet? I mean, has someone opened a new case, and could it really happen? What's kind of the adjacent or all of the First Nations that could be influenced by this?
Yeah, this is a super complex topic, and it's I don't know, I can't speak to every project situation and why these things happen in some cases and not others, but I can certainly talk about our situation and our approach to this, which is pretty straightforward. We seek to engage with all potentially impacted nations early and with integrity and with transparency and honesty, and invite them to site and tell them what we're doing and all that stuff, right? Just kind of basic stuff. And you obviously learn as you go along, and things change as you go along in terms of footprint. So especially with things like power lines, you make a choice at one point in time where you're like, oh, this might need a power line going through this area. Therefore, the footprint of the project changes right at that point in time, and you need to reach out and kind of see what some of the impacted communities or First Nations might be on that new element of the project footprint. So we have been doing all that stuff. So we certainly believe that, and I think our disclosure in the PFS was quite robust around this. We have itemized in that public disclosure who we are engaging with and the sort of approach to that engagement. We believe that it's comprehensive for the immediately impacted nations. There's always the prospect of kind of downstream stuff. So there's water courses, there's watersheds, and there's folks that are hundreds of kilometers away from here that may put their hand up at some point in time, and that's kind of part of the the process here, and that involves all kinds of interactions with the regulators and the Crown and us as the proponent and other First Nations who have perhaps more of a high priority claim on impacts and so forth. So that's all part of the EA process. Like that's normal, and we're preparing and prepared for that. But I think the work that we've done thus far is good work, and we've covered a lot of the nations that are in a very broad area around us. And it's not just, to be clear, it's not just like in BC, it's not just like communities that you're close to. It's also rights holders. So there's like traditional territory where there's where there's like Aboriginal rights in place, and so the presence of the project, the fact that you're going through a Crown governmental-led regulatory process, those things impact rights and title. So even if the actual physicality of the project does not have an impact on any person's livelihood or community, the fact that it's like overlapping with rights is what kind of brings nexus to a lot of this stuff. So we're really on top of that, I would say, and we're working with all the different groups in the different ways that they want to work together. And in some cases, that's like cohesive group discussions, and others it's like really just sort of one-on-one type engagement. And yeah, I mean it's a big part of the job ahead of us, and we're cognizant of what's involved in that, and have lots of advisors in place and funding in place to do that. And but we're also confident that this is a project that holds a lot of promise to bring significant economic benefits to this region. Our feeling is that folks are aware of that, and they see the benefit and are interested in that. But they're also very interested in environmental stewardship, as are we. Like me as a person, like all of the executives and board of SURG, and obviously just best practices in this industry. Everyone wants to do things in a way that upholds our environmental stewardship and all of our kind of objectives around reconciliation and just being good citizens, good neighbors, good corporate citizens, and so forth. So that's the way we're approaching this.
Staying on the topic of timeline here, Leif, what about when do you think you can have the FS out, or what's the plan right now?
Yeah, again, I would just try to guide people to this is an end of decade project. Got a lot of work ahead of us. There's going to be a lot of catalysts and incremental developments along the way. That'll be a range of technical work, commercial developments, EA milestones, all this sort of stuff, and that kind of all goes into the pot of de-risking and advancement. But I would say at this point we hold it as an achievable aspirational goal that we will be approaching a similar situation to what Skeena's in right now, by the end of the decade. So kind of EA approval coming in, Mines Act permits sort of, close succession right behind, project financing components in place, team being built, all that stuff. That's kind of the journey over the next several years. So people could think of it as like an end of decade project, 3-year construction decision, 3-year construction period, I should say. So depending on how rapidly that transition takes place, could be first production in the early 2030s, roughly.
Right. How are you going to keep the market happy in the meantime, being in the throes of the Lassonde curve? How do you plan to defeat the Lassonde curve is essentially what I'm asking here. Is it defeatable in the first place with what you've got?
Yeah. The Lassonde curve is an interesting topic. So, I mean, the usual mental model there is equity investors are short-termist and want big changes to NAV to be big changes to value to be coming in the form of transformational discoveries and things like that along that pathway. Ergo, the Lassonde curve implies that you kind of establish value through something like a PFS, and therefore that baseline value isn't changing, and it's just kind of stagnant in time while you're going through the work that we have ahead of us. and you should be combating that with like parallel exploration activities. So, I agree that that's a logical mental model, and certainly applies in some cases. In our particular case, I'll just say that the shareholder returns can come simply from the value of what we've delivered already being better recognized in the market, and so we will be surfacing that value through communication. I think that process is like well underway. I think the equity value of this company has room to grow very strongly without a single additional, catalyst, so to speak. And there's plenty of examples out there of that. Like I think, can point to some of our peers out there that like Solaris. I mean, their share prices, I don't know, doubled in the last year with very little news flow, right? So it is kind of like appealing. It's an appealing mental model that catalysts in the form of things like drill results are what move stocks, but you could find plenty of counterfactuals to that. So I certainly think that like we've delivered an excellent result. That excellent result is a rarity in the market. So this is a strategic asset that should continue to come on new investors' radar. We hope to see like a further institutionalizing of the register, and that should be a virtuous circle of like getting more and more eyeballs on what we're doing. And then on the actual like fundamental business side of things, like the work that we will be doing is going to be de-risking the asset. So to the extent that the NAV, like the NPV or the NAV is constant, that you have this kind of, multiple or like discount on top of it, which is like the risk factor. So we're going to be delivering catalysts that should reduce that risk and therefore should garner a higher multiple over time. And then the last piece is kind of what you're referring to, like, just other stuff that's additive to it. So this is a district that has, I mean, we talked about Ootsa a little bit, like we have a second project that's in the same contiguous land package. It's in the same cohesive thematic district. There could be stuff that happens there of a corporate development nature or of a like exploration discovery type nature in the coming years. There's also a very strong pipeline of regional exploration targets that again we could decide at any time, subject to like just sort of financing comfort and other things to advance some of those. So yeah, I think catalyst wise, there's a lot to look forward to around just better recognition of what's there, fundamental de-risking that should surface higher, multiples on the NAV that's already there, and then additive stuff around exploration and corporate development that's all kind of thematically tied together in this, big copper district.
Is Ootsa going to be part of that plan?
Well, that's kind of what I'm referring to. Yeah. So Ootsa is like there's a lot of I think we've drilled 15,000 meters there after our last resource update and have hit some interesting stuff. So there's kind of uncaptured fundamental value there. So will we at some point progress a resource update, maybe a standalone PEA there? Like those are things that are, rolling around in the back of our head, and I think can be positioned at the right time in the right way as quite compelling. It goes without saying that like our this isn't a controversial statement, but like our opinion for a long time on Ootsa is that there's a logical business case to be made for those deposits to be integrated in some way, shape, or form with the operating platform at the Huckleberry Mine and Mill. And that mine, it's still on care and maintenance. Its owner operator, I think, has disclosed recently that they will be putting forward a restart plan later this year. So who knows what that could point to? But if that mine goes back into production in the next, couple of years, I think there will be a renewed focus on, what is the long-term plan for that asset and that infrastructure. How do the different deposits in a conveyable or truckable radius get configured into that? And that could be Whiting Creek which is one of their exploration properties, or we think Ootsa is a pretty logical contender there. It's a few kilometers away, line of sight. You see the mill from the deposits, and I think it can add a lot of value there.
Yes, that's the only thing I'm going to say there, but that is true. Why I ask you whether Ootsa is going to be part of that is because I'm thinking, why not monetize it? I mean, you can argue that you're not even getting value for this asset that you have right now for Berg, and therefore definitely not getting value for Ootsa. Why not monetize it in some type of way, option it, or do something else with it, spin it out? I don't know.
I mean, certainly some of the things on that spectrum would be of interest to us. So, I mean, just to put a fine point on it, like if there was a monetization option on the table involving Huckleberry, like vending it into that and having a JV interest in that asset, or anything on the spectrum related to that asset, absolutely, we would be all over that. I think the concept of just saying the market doesn't value this, so we're going to like spin it out. I don't think that really achieves much for us, or it might even hurt us. And the reason for that is, when I think about like M&A mentality for these sorts of assets, having a big project with a big NPV and all that sort of stuff as an anchor is a must-have. But then also having a big land position with exploration, prospectivity, and other kind of like visibility on developments down the road. That stuff is really important, and I think it can be very valuable, and it can be fairly valued in the context of a transaction. And if it's not, well, then you can spin it out then. Like if you can't come to terms on adequate value for an asset like that with a book value and a maybe like a PEA value in place at that time, and you can't come to terms on it, well, you preserve the option all the way up until that point to spin it out. But I think prematurely spinning it out preemptively for just because you feel like you're not getting value, I think that actually undermines the big picture goal around keeping a coherent, strategically relevant, contiguous land position together. If Ootsa was a totally separate project in like Newfoundland or something, sure, we might spin it out. But it's strategically relevant to the core business that we're involved in.
Right. Yeah. Well, I think I've been through most of the stuff here, timing and everything that we've talked about. I'm sure I'm forgetting to ask you a bunch of stuff. I'm sure you're going to be back on the pod sometime soon, though, and people watching and listening can tell me what I'm forgetting, and then I'll ask you about it next time. Bit of a housekeeping here. $32 million private placement is coming free trading soon. Is that a bit of an overhang? What are the expectations there? Do you have the ability, I guess, either as management? I saw you guys exercise some options on the SEDI filings, but you have the ability either as management or the ability to find someone else to mop up any potential supply that can come?
I'm not terribly worried about it, to be honest. That deal was put in place or done at a time where like we didn't need to finance. It was something that was kind of investor led, and there was a big discussion around it in terms of who the placees are, and this inclusion of a warrant was of a very kind of strategic nature. So like at the time that we did that deal, a lot of our peers were out doing like $100 million bought deals with like very thin discounts. So we definitely did not need to do a full warrant unit deal at that time. We chose to do so because it provided a structure for us to have visibility on this funding runway all the way to close to FID. So $60 million we view as being, it's not a fortress balance sheet for by any stretch, but it's like it could definitely under some circumstances carry us all the way to the finish line. And so we were happy at that time to take 20 off the table before our PFS with a pre-wired 40 that would come at 100% premium from a group of investors that we had a lot of faith in, that they were, like-minded, long-term, fundamental investors. So the book was very strong. A lot of A-list name brand mining investors in it. Our perspective is like they certainly are not the types of investors that need to or will want to sell at a like nominal profit on their common shares to quote unquote ride the warrants. That kind of typical warrant clipping behavior is pervasive with some segments of the market, but I think the book that we built that's not our expectation. I think it's the stock is in very safe hands. And furthermore, like those warrants are non-transferable. So our perspective is like we know who's going to be providing the next 40 million of proceeds to the company at what price. So it's kind of intended to be like long-term relationship type money. So I'm not concerned about that. Is there going to be a little bit of stock coming from some of the smaller orders there? I don't know. I mean, we don't have a contractual thing in place to prevent that, obviously, but it's not something we're concerned about. And as we started at the top of the discussion here, we've just churned through like a larger amount of stock than that from the Centerra piece that I was talking about.
The money that you have right now that you just mentioned, Leif, how far does that take you?
Yeah, a couple years into the like budget funding plan. So we're in a very strong position for the work we have ahead of us. And given how cheap the stock is, like just on a multiple basis, it is the expectation of us and the subscribers to that placement that the share price will, re-rate in the fullness of time, and those warrants will be able to be accelerated at some point, and we'll get some additional funding, and we'll be, we'll kind of maintain some good tension there.
So no need to come back to the market right now at 50 cents.
No.
Okay. Good. Oh, good for you, I suppose. What keeps you up at night? Like we've talked about a lot. Again, I'm sure I'm forgetting stuff. I'm already taking more of your time than what you'd promised me. So what keeps you up at night? What do you think are the biggest risks for Surge from here on out?
Look, I mean, the journey we're about to embark on environmental assessment and permitting in BC is it's new for me. We obviously have other executives in the team who have done it before. We have directors who've done it before. But you asked me what I lose sleep over at night. So me personally, it's a lot of new stuff. Like I'm kind of a technical financial guy, so that stuff is home base for me, very comfortable for me. A lot of the politics is kind of new for me, and that dimension of stuff is new. But we're taking all the right steps to prepare for it. We're bringing in the right people, both like internal to the company and advisors and so forth. And look, I think the track record in BC, there's like a lot of recent data points to demonstrate that the jurisdiction is very serious about exactly this, like improving investability, improving timelines. There is the complex overlay of of Aboriginal law that is hard for a lot of people to understand. We as folks that operate in the space are comfortable with it, increasingly comfortable, and we're going about it, I think, in the right way. But I mean, to answer your question, I think that's an area where there's a lot of uncertainty. Like I certainly don't lose sleep over the resource model or the metallurgy or stuff like that. And then just the market, right? Like the market is a ineffable thing. Like Surge has traded at a discount for a long time. My view on things is it's the whole kind of voting machine versus weighing machine, euphemism or cliche from Munger or whoever it was, Buffett. But there's from a weighing machine perspective, we have delivered, I think, the goods here. Like this is a very solid project. I think everything that we've talked about here is very logical. I think this project is moving exactly in the way it should. But on the voting machine side of things, the market is just sometimes confused about these things and just doesn't. And it's like it's reflexive, right? The market is a lot of people come at these things with an attitude of efficient markets, and so the market is right. The market somehow knows something that I don't or you don't or whatever, and so just combating that is it's a hard part of the job for sure. And so yeah, like do I lose sleep over that? Like we've done a very good job, I think, of accessing capital and doggedly progressing this stuff. But getting to the finish line, getting like the proper recognition that this asset deserves is just a huge focus for me right now.
I'm just waiting for one of these days where I'm going to ask someone what keeps you up at night, and he or she's going to go annoying interviewers like yourself, and I'll just have to stand there and think what to say in return. I think we've been through, again, the vast majority. Just looking at my notes, not much else that I could ask here. Maybe a note on marketing. Are you going to ramp up marketing from here on out, now that you have kind of set in stone pre-feasibility numbers here to talk about, or are you going to
100%? Yeah, it's like a top priority for me. I mean, marketing, permitting, and sort of advancing some of the commercial stuff on the business are all my top priority. So it's hard to balance it all, but absolutely, like we're very proud of these results, and I'm very excited to tell the story to people, answer questions, and I have a mandate, and it's my like duty to get on the road all over the world, but virtually and physically, to tell people about what the Berg Copper project is all about and what SURG is doing and who's behind it, and my view is this is like at a point right now of technical maturity where it deserves to be on everyone's radar. So even if people are running screens and saying, look, the market cap is too small, the liquidity is too small, I don't look at it. The asset is, if you're interested in copper, which everyone should be, this is a must look at copper asset. So yeah, I'll be doing a lot of marketing.
Yeah. Well, good. I really do appreciate you putting so much time into this conversation. Sum it up here for me at the end, and then I'll let you go. The catalyst calendar, what is that going to look like over the next couple of months? If I'm paying attention to the news releases, what am I going to see in there?
Some stuff around the field program. So we'll put some disclosure out, providing not just details, but like context on what that's all about, how it fits into the bigger picture. There's probably further corporate growth type stuff. So people coming into the picture, just further maturing of the corporate organization. There is that kind of bright line milestone of entering the environmental assessment process. So again, that's like a formal thing. It usually comes with fanfare around town halls and discourse related to the government's acceptance of the application and so forth. There is, and we're going to be embarking on lots of commercial stuff as well. So starting the journey on project finance and offtake stuff, and so that's maybe not like super near-term dated milestones, but I think folks can expect to see a mix of technical progress, results from that technical stuff, corporate development things, commercial development things, and then milestones as we reach them on the kind of permitting side.
That's a great way to end the conversation on. Really appreciate your time, Lee. Thank you so much for sitting down with me today.
Thank you very much. It was enjoyable as always.
And before everyone leaves, though, I still have a couple of more things to say. The fact that this company was interviewed here today doesn't mean they're necessarily a good nor a bad company. We're not here to endorse or attack anyone. We're simply here to ask a few questions. If you find that we have failed in asking a question that you would have liked to hear an answer to, please let us know by emailing Antonio at resourcetalks.com. and we will try to correct that mistake in a future conversation. If you made it that far, you probably know this, but I will remind you nonetheless, mining is a risky business. Losing money is the norm and should be the expectation, as mineral exploration, development, and extraction is an extremely risky industry where the performance of individual companies typically depends on many different moving parts, including company-specific factors like geology, financing ability, hiring methods, and many others, as well as other things that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more. Too many to list here, really. Moreover, these companies are typically in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which often results in shareholder dilution. They raise money by issuing new shares. Even if the CEO promised they won't have to raise capital anymore, I've seen it over and over again. It still can, and it does happen, which is why you need to stop and think. You need to do more research and not rely solely on what the company tells you. Furthermore, as a general rule of thumb, you'd be better off understanding that all company communications, albeit this interview or their website, their presentation, their news releases even, and of course their social media and everything else, all of that is intended as marketing. And although we at Resource Talks do not make buy or sell recommendations, even if you ask us, we just don't do that because there is a clear conflict of interest given the nature of our business, which sells content producing services to these companies. Even though we don't do that, many accounts and channels out there do that. Exactly. They do give out direct recommendations, even though they are often paid for opinions and they're worth just as much as you paid for them, which is to say nothing. And you should be aware of that inherent bias. You should not blindly trust people on the internet. That bias is not always going to be clearly disclosed with everyone out there. So it's just safer for you anytime you're watching any type of company specific content to approach it with a big dose of skepticism. And just assume that the party telling you about it is biased, oftentimes in multiple ways. They might own shares, they might be paid by the companies, or I should say they often are. And that bias is not always going to be clearly disclosed with everyone. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentive, but instead double check if what they're saying is true by using setterplus.ca. Unfortunately, at least in my understanding, nobody out there has any special predicting abilities. The CEOs don't possess any superior knowledge and they cannot know about what's going to go up, what's going to go down, or what's going to go in circles. And none of us know whether any of the company's activities that we discussed today will result in a success. Again, given that we're talking about very high risk activities where most of the times it ends in failure. The vast majority of the times it ends in failure. Also, unfortunately, try as I may, we won't always catch all red flags or all challenges with the company. So even if we did ask a few tough questions in this conversation, don't rely on this being all of the important and tough questions. Again, these are complicated startups with many moving parts. They require rigorous, I'll try that again, but they require rigorous due diligence. Resource Talks and its hosts cannot guarantee the quality of anything presented in this video, and you cannot hold the company, the channel, or its host responsible for any losses or damages stemming from the way you decide to use the information you're just presented with. Viewers, listeners, and readers acknowledge and agree that the information presented herein does not constitute a solicitation or an offer to buy or sell any security or instrument or to participate in any trading strategy. Resource Talks and all parties involved in the management of this business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, howsoever caused, arising out of any use or reproduction of the content published and distributed by Resource Talks, or any decision made or action taken in reliance upon it. By consuming this content, all viewers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. You know, this is all to say it's a lot of lawyer talk, just saying you should not blindly trust us or anybody else on the internet. And you should always do your own research, as cliche as that may sound. Once again, social media is meant for entertainment. Setterplus.ca is where you do research. That's an official government website. That's where you find the companies official filings. And I encourage you to read and analyze the management information circular, the financial statement, the management discussion and analysis, and whenever available, the NI 43-101 technical documents at the very least. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. As mentioned earlier, the chances of even the best analysts in this sector losing money are very high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I'd listened to more often earlier on in my career, which says, quote, "If you don't understand it, don't do it." Unquote. Thank you all for listening, and I wish you a great day ahead.